Welcome to Buy, Hold, Sell. I'm Jeremy Hook from TMS Capital. Joining me today on the panel, we've got Daniel Moore from Investors Mutual and Tom Richardson from Watermark. We're going to look here at quality stocks in the top end. We're going to look at screening them for return on equity, earnings growth and debt to equity. And then we've got to ask ourselves, are they good value or not? So let's go first to Daniel and ask him about Cochlear, which is certainly had a good run. It went through $200 quite recently. Is it a buy, hold, sell?
Sell for us. Fantastic company, really good IP, but at 40 times earnings, we're a long way away.
Definitely good returns on equity and things. You get excited by the stock, but you've got to get the price right, haven't you, Tom? Buy, hold, sell Cochlear.
Yeah, sell for us. Hate putting a sell on fantastic businesses, but this one's in the stratosphere. And the Investor Day a few months ago, they did articulate that OPEX was going to increase, and so we think the estimates for forward earnings are probably a little bit high, and when you're on 40 times, not a lot of margin for error.
No, Flight Centre has taken off lately. Great balance sheet. Buy, hold, sell.
That's a hold for us. I mean, the business has gone through a transition where for many, many years it was just growth, growth, growth. They went through a series of downgrades a few years ago, and that focused them more internally. They've taken some costs out. They had a bit of reflation in ticket prices. But we think it gets a little bit harder from here. They've got some medium-term targets, which the street has already met, and so we think it probably has to do a bit of time here.
Daniel, Flight Centre, doubling in the PE while the price is almost trebled. Buy, hold, sell.
Today it's a sell for us. It's trading on 21.5 times, which is a 15-year high for the company. Just too rich for us.
Yeah, the market's fallen in love with that. One that it's been unsure about in the past has been Blackmores. A very rocky run, good return on equity, meets that criteria. Valuation a bit too high now. Buy, hold, sell.
Yeah, again, sell for us. 30 times earnings, just too high for us considering the earnings volatility of the past. I think in 2014 its earnings fell 40%. That's a big multiple for a company that can deliver that sort of outcome.
Tom, Asian strategy key to Blackmores and its future. Is it a buy, hold, sell?
Yeah, it's actually a buy for us. We think we've rebased some of those earnings out of China. We think it's a great growth story. We think that the Chinese consumer is a well understood thematic. But the thing we like about Blackmores is they've been there for a very long time, and their international expansion started 40 years ago. And it's not just China, it's Southeast Asia. So we think the growth story there has legs. It's a buy for us.
And Tom, in your research, you must have come across a good stock for the viewers to watch and maybe buy that has a good sustainable dividend. What is it?
Yeah, we like Downer for a good dividend yield. They've obviously had their spotless transaction, which is a little bit risky. And some execution issues there. In fact, the Royal Adelaide Hospital is obviously front of mind for everyone, and they may have to take a provision, but I think that's very well understood from the market, and that's the opportunity. There's some really good growth opportunities for the company, both mining capex, oil and gas capex, as well as infrastructure maintenance over the next 5 to 10 years. We think the company is really well positioned, especially with some of their peers being taken over by international companies. Yeah, we like that story.
Great, thanks, Tom. Daniel, there is a clear difficulty getting value throughout the market, but have you got a special for our viewers?
Yeah, sure. Brambles for us is a buy. Very underloved at the moment, trading around 16 times, which is a 6-year low for the company. Has some short-term issues. You need short-term issues in this market to be cheap. It has some, their input costs have been rising, and that will impact the earnings in the short term. But if we look sort of 2 to 3 years out, we're actually quite optimistic on their ability to increase prices, as most of the markets they operate in is a duopoly. So we think the market will be more rational than what people think, and today you can buy it on a reasonable multiple at pretty low margins.
Well, there's a couple of very good ideas for you. Remember, price is what you pay, value is what you get.